Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I tell.
All right. Hey guys, my name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And sit tight, friends. You are in for an awesome show this week. Hey, I've got a question. What does an all-you-can-eat buffet, one of those belly-busting sneeze guards, load your plate full, right? Lunch or dinner buffet. The old Clash song, Should I Stay or Should I Go Now? In today's housing market have in common. If that sparked any curiosity, hang in there with us. We're going to dive into all of that and so much more. We've got a great one lined up for you. You are in the right place. If you want all of the tips, tricks, and strategies and answers to your questions so you can go out and make better real estate and mortgage decisions for you and your family. Guys, a lot of excitement around the Federal Reserve meeting last week. And the interest rate market's reaction, right? The mortgage market in particular had a very, very favorable reaction. And my question is, did the Fed just set the table for one of those belly-busting buffet experiences? Hey, let me explain. So the human nature in Americans when it comes to the all-you-can-eat buffet, and some of us have experienced this firsthand, and others certainly have witnessed it. We have a tendency to pile as much on our plate as possible. I mean, an uncomfortable amount of food. And we'll visit that buffet often one, sometimes too many times in an effort to get our money's worth, right? And what do I mean by that? People want to get all they can for that payment, right? And in housing, that equates to the monthly payment. And we're going to end up, I promise, in the housing market. But think about that for a minute, guys. You've seen it, right? You've seen that man or woman or child at the buffet just loading it up. The fried chicken, the fish, the prime rib, whatever it is. The plate overfloweth. And then they go up for a second plate. And then a third plate. And then wait, here comes the dessert bar. That vanilla and chocolate swirly ice cream together with the M&Ms and all the sprinkles on top of it. People hurt themselves until they're uncomfortable. You can see it in their face. They reach down and loosen their belt or unbutton their pants. That's the American, right? Our mentality of the all-you-can-eat buffet. And we see people do it in all aspects of life. They buy more than they need because they think it's on sale or it's a great price. How could I pass it up? That's a flawed human mechanism that we all have. Well, we saw that in the housing market, right? We saw that when money became so cheap, people could afford more than they ever imagined. And the first people in line won. Don't get me wrong. The first people to market in this appreciation cycle based on free money, they won because they bought the house for $300,000 or $400,000 when in the past they might have only been able to afford $200,000 or $300,000, and then they rode that appreciation wave into a bunch of equity. Now, the trick to that is getting ahead of the curve, and we saw that happen. And I share that story because I saw many people when rates were moving up. They were looking at homes at 300 that, in a very short period of time were now 400,000 and they could no longer afford it at the same time that money doubled in cost. They got priced out of their ideal market, if you will, and had to settle for something far less. Well, guys, the Fed just insinuated that the worst of inflation is over and they're pausing any further hikes, which a lot of people read the tea leaves to assume that there are cuts coming. I'm not convinced cuts are coming anytime soon, and certainly not at the rapid pace that some people are forecasting. But nonetheless, the mortgage market reacted favorably, and we saw rates fall in the last couple of months 1.5%. Guys, that's huge in the mortgage market. A 1.5% decrease in interest rates, that's significant. And here are the numbers to illustrate that. Guys, a $300,000 loan at an 8% interest rate, and that's where we were at the end of October, is $2,200 a month, principal and interest. Well, where we are today is 6.6% and falling. These numbers could be even more dramatic next week, and we could touch on them again. But my point is, at 6.6%, that same $300,000 loan costs $1,900 and change. And these are round numbers, guys. There's, $10 or $15 here or there. My point is a $300 difference. Same loan 6 weeks later, same loan 2 months later. Well, here's what happens. This is human nature. This is that buffet effect. Get ready to reach down and loosen your belt, because what most people are going to do is say, wait a minute, I'm approved for $2,200 a month. $2,200 a month at 6.5%. Now I can afford a $345,000 loan. So what happens? Prices accelerate. Appreciation accelerates because people are starting to buy that next bracket and buy that next bracket. And we saw it happen. $200,000 homes become $300,000 homes. So the guy in the middle and the end of that curve ends up with the same house, paying more for it in the cost standpoint, but the same monthly payment because they're using a lower interest rate in qualifying. That's the buffet effect, guys. And if rates continue to fall, or if you use a buy down strategy, a $2,200 a month payment at 5.5% interest, you qualify for $390,000 principal and interest. So if we are truly moving into a further lowering of interest rates in the mortgage market, what's going to happen to housing? Is it better now to buy the house with the 6.5% interest rate or 6.75%, whatever your program shakes out at, pay a little bit more in interest, get the house you want, and let the buffet buyers, when rates fall and everybody runs into the market and starts stacking their plate with as much as they can afford, build equity for you? Or do you want to wait and be one of those buffet buyers and be in a more competitive market with less negotiating power? Because today we're still seeing sellers willing to give concessions, help with rate buy downs. And in the winter months, the market's traditionally slower. So there's fewer participants on both sides, guys. So there's a more level playing field. If we get into an environment where everybody's back in the game, what is that going to do to A, prices, and B, the competitive nature of making offers on properties? Guys, and I don't have a crystal ball. I don't. I mean, I'm of the mind that rates are going to fall somewhere to the 6% range and stay there for a while. And I don't think the Federal Reserve has a bunch of rate cuts in them next year. As a matter of fact, some of the Fed presidents came out last week after the exuberant reaction of the market and said, hey, guys, wait a minute. We're not even talking about rate cuts yet. But that has nothing to do with the mortgage rates. What's happening in the mortgage market is a result of the overall economic reaction to the Fed meeting, but it's not directly correlated with projected rate cuts. So I just want to get that clear. So my point is, should I stay or should I go now? So we worked the Clash, right? The song, the housing market, and the buffet all into it. Should you pull the trigger now on a purchase and refi later if rates continue to fall, or wait for rates to fall, the market to become hyper competitive and get into a more rapid appreciation cycle again? I think if you had your choice between the two, buying now may make sense. But again, it doesn't always make sense for everybody, and I don't have a crystal ball. And refinances are not free. They're easy to throw around, but they're not free. However, if low interest rates spur a lot of market activity, which then kicks up appreciation, you can use some of that newfound equity to fund the refi. And in that example that we just shared, we saw how quickly 300 can become 390. So that may make sense for somebody. Guys, you hear the music, you know what that means? No more song. No more dance, no more musings from Mr. Mortgage. We are going to jump into a very, very short break. And on the other side of this break, we'll be back with more of the Mr. Mortgage Show. Sit tight. We'll be right back.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Guys, if you have questions or comments, we appreciate and encourage your participation. And you can get your questions on the air by calling or texting 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And Jen is womanning the hotline, and she will get your questions on the air. Or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. You'll see the big orange button that says Get Your Questions on the Air. Just click that button and follow the instructions, and Jen will read your question on the air. But speaking of questions and Jen, she's got some already queued up back there. Let me throw it over to Jen for question number 1.
Stephanie sent this one. I've read that VA loans are assumable even by non-veterans. Is this true? I am not a veteran. Is there a catch?
Hey, Stephanie, this is a great question. And right now, assumable mortgages are getting a lot of conversation because people have historically low interest rates on their current homes. It's super appealing to assume a VA loan if possible. So you're right. You are absolutely correct. A non-veteran can assume a VA loan. FHA and USDA loans are also assumable, but a big thing that very few people realize is that a VA loan can be assumed by a non-veteran. Now, here's the caveat, or the catch, if you will. You asked what the catch was. With the VA loan, if I'm a seller and I'm a veteran, I have what's called my entitlement. And that's what allows me to qualify to use my VA loan and get the quote unquote 100% financing and buy the property with that loan program. If I sell the property to you, a non-veteran, and allow you to assume the loan, you qualify for the loan, the servicer says yes, you buy the property, my entitlement is still tied to that loan. It's not on my credit report. I don't stand any negative repercussions from a credit standpoint, but I can't go out there and use my full entitlement again because at very least part of my entitlement is tied to that existing loan. So veterans don't love the idea of allowing a non-veteran to assume their loan when selling their property for that very reason. Because if you're in that house for 20 more years, that veteran's entitlement is tied to that loan for 20 years, unless you refi it before the 20 years. But as long as you have that loan, that veteran's entitlement is tied up to it if you're a non-veteran. That's the only thing. Another thing to consider when assuming a loan, and this goes with any loan, you're going to be required to make up the difference between the loan amount and the purchase price. So if the existing loan is $300,000 and you're buying the property for $400,000, whatever the loan type is, you're going to be responsible for that $100,000 difference. And the last thing that can be a bit of a challenge with a assumable mortgage transaction is the timeline. They don't happen quickly. So if everybody's on board with an extended timeline and the veteran's on board with allowing you to assume that VA loan and his or her entitlement being tied up, then it's a great, great opportunity. And as I mentioned, they're getting a ton of conversation right now because I'm seeing, 3%, 2.875%, 3.5% assumable mortgages being advertised out there. And we talked in the opening segment about how much a lower interest rate can move the needle from the payment standpoint. So if you're looking at a property today and you're thinking of borrowing $300,000 and putting $100,000 down, to keep this example the same, at 6.5%, or you could put $100,000 down and assume a $300,000 loan at 3%, man, your payment is going to be much, much lower. So I completely understand the people's desire to go through those additional steps, because it is worth it if you can pull it off. So great question. If anybody has additional questions around that, please give us a call or shoot us an email or a text. I'll be happy to elaborate. But that's a great question. Thanks for that one. Hey, Jen, can we get another question in? Okay, go ahead.
Jonathan is asking, how does buying a house with solar panels work? Am I required to take over the solar payments? Do the panels add to the appraisal?
Oh boy, Jonathan, this is a great question. And man, oh man, is it a hot topic right now. So buying a property with solar panels can be super appealing from the buyer's standpoint, because the assumption is you're going to have no or a very small electric bill. And I get it, right? I totally understand the benefit of having that opportunity. But here's the challenge. A lot of those solar panel packages were financed or leased. And if they're financed, it's basically like a second mortgage on the property. And oftentimes the seller is wanting you to assume that debt. Now, if the value of the property can support it, great. But you're going to have to qualify with that additional payment in your debt to income ratio on the mortgage side. So we're going to treat it like a second mortgage. It's going to be first mortgage plus solar panel debt when doing the equation. And I know I can hear everybody out there, and I feel the same way. Why would you count a payment against me on solar panels if I'm not going to have to pay an electric bill? That's just an example of the industry hasn't caught up, because it's logical, right? If my electric bill would be $300 a month, we don't count utility payments against you in the debt to income ratio. Why would we then count the solar panels? Because it's a lien on the property. If they're leased, it's the same thing. That payment's going to be required to be calculated into your debt to income ratio. Now, you can negotiate that the seller pay it off, especially if you've determined that the panels added value in your mind to the property and you are willing to pay more for the property because the panels are there. Then you would expect the seller to sell it to you with the panels on it, and you not have to then, basically you're buying the panels if you're assuming that debt. So it gets a little sticky from that standpoint. And we've actually seen sellers not have enough equity in the transaction to pay the solar panel debt off at closing, and the buyer in that very same transaction not have enough debt to income ratio room to assume it. So we've seen that actually kill transactions. And then lastly, before you get too far down the road, get a hold of your homeowner's insurance agent and make sure you can get insurance on the property or affordable insurance, because there is a whole nother consideration when it comes to insuring a home with solar panels. Great idea for sure, but there are some nuances to the transaction. So I hope that helps. That's a great question. We're seeing more and more of it as these solar panel salesmen certainly have done their job and knocked on every door in some of these communities. But I hope that helps, Jonathan. If you need more info, just contact us off the air. I'll be happy to discuss in detail your circumstances with you. Hey guys, you hear the music. You know what that means. That is my cue. We'll be back in a few. On the other side of this very short break, we're going to dive into more of your questions, whether it's solar panels, equity lines, reverse mortgages, whatever you have, throw it at us. We're here and happy to help. But sit tight. We'll be right back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
We're back. Hey guys, it's Mark Eitel, and you are listening to the Mr. Mortgage Show. And if you want your questions or comments on the air, just call or text 855-462-7292. 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Jen is womanning the hotline, and she will get your questions on the air. One more time, that's 855-462-7292. Or head over to mrmortgageradio.com. That's mrmortgageradio.com. There's a big orange button right in the middle of the screen that says get your questions on the air. Click that button, follow the instructions, and Jen will read your questions on the air. That's mrmortgageradio.com. But hey, let's keep the questions coming. Jen, are you ready? Go ahead.
Connie texts this. Is it possible to buy 3 triplexes with one mortgage? We'll be buying them from the same seller. 2 are cash flowing, but 1 is negative. That's why I'm thinking one loan may be smart.
Hey, Connie, that's a great question. And when Jen was reading that question, I was a little curious why you would want to do a blanket mortgage on triplexes, because getting a partial release and selling one at a time is a little bit more of a process than just having individual mortgages. But now I get it, right? Because 2 of the properties are cash flowing and 1 is not. So the assumption is dead on and super logical that the additional cash flow from the 2 properties might absorb the negative, and then the 3 properties together as one, if you will, are cash flowing and will support the debt. So great question. You've obviously done your homework, so congratulations. The answer is yes. And you can use the landlord loan, which is the loan that evaluates the income only from the properties. It's a DSCR, debt service coverage loan. That's the landlord loan. You can use the landlord loan as a blanket mortgage on multiple properties. The only caveat going into this, you'll want to be aware that selling one or refinancing one is now a challenge. Actually, refinancing one is now not an option, but selling one at a time, should you wish, requires a partial release of lien, and it's a bit more cumbersome than just selling them if you had individual mortgages on the property. Now, one thing that I want you to be aware of is that the landlord loan can be used on a property that has a negative cash flow position. So there are some other considerations that need to be met, but if it's helpful to your long-term goals that you have 3 loans and 3 liens so you can refi one at a time or sell one at a time, you might want to consider that first. But to answer your question, the blanket loan is available in this circumstance. So great question. I hope it helps. And as always, if you or anyone needs more information about that, please contact us. I'll be happy to help any way that I can. All right, Jen, throw me another question.
Wendy has a question. We applied with another lender before we found you. Now I think their system was hacked because I'm getting tons of phone calls from mortgage companies who have seen my application. Is there anything I can do to make sure my info is safe?
Okay, this one drives me crazy. So very, very first thing you need to do is exhale. The good news, if there's any good news in all of this, is it's highly unlikely that the mortgage company system was hacked and that your personal information is flying around out there somewhere on the internet. You are now what the industry calls a trigger lead, and it is the ugly side of the credit reporting agencies that we all hate. When I say we, I mean the mortgage industry. We're all lobbying against it, with the exception of a few big call center mortgage lenders. And let me explain. What happens when you apply for a mortgage? Your credit is pulled from TransUnion, Experian, and Equifax, right? They're the big 3 credit reporting agencies. That's where we get your payment history, your credit score, your balances are in those repositories. We get that data from them. They control that data. We're obligated to use that data as part of the underwriting guidelines for mortgage activity in the United States, which puts all of the control in the hands of these credit reporting agencies. Well, guess what they do, guys? You apply for a loan, you are now a trigger event. Car loans, the same thing, but mortgages is where it gets ugly. You apply for a mortgage, you are now a lead in their system. They sell your information to dozens and dozens of mortgage lenders out there who are going to crush your phone with unsolicited offers, and some of them are devious. Some of the phone calls will insinuate that they're working with your mortgage company and need your documents to get your loan moving in the hopes that once they have their documents, they can sell you on using them. I've heard the horror stories, guys. It's not pleasant. So it's the Trigger Lead system. Experian, TransUnion, and Equifax sell your information to other mortgage companies. Now, they don't have your full social security number. They're not able to apply for credit in your name, but they have enough information to fool you into thinking they're working on your behalf when they call you. And not all of them are unscrupulous. Some of them are going to offer you a competitive quote, and they're upfront with how they got the data. But I'm sure you're experiencing it. Some of it is super, super confusing. So it's called Trigger Leads. Now, guys, anybody who is thinking of applying for credit in the future, you might want to consider opting out of this. You can go to optoutprescreen.com. That's optoutprescreen.com. If anybody has questions, text me or email. I'll send you the link, and you can opt out of the Trigger Lead database from the big three credit reporting agencies. It's unlikely that it's anything your mortgage company did to jeopardize your data. It's highly likely that you are a trigger lead within the credit reporting agencies. And guys, like I said, it is super, super confusing because all of a sudden you're getting a ton of phone calls saying, hey, we need your bank statements. We need this. We need your certificate of eligibility. And you can be fooled into thinking that you are talking to your mortgage company. I've heard more stories than you would ever imagine. We do our very best to educate our clients on what could happen based on this trigger lead scenario, but we also try to get everybody through the opt-out pre-screen link as early in the process as possible so that we have a good chance of keeping you out of all of that craziness. Hey, if you're lonely out there, guys, you're sitting around at home with nobody to talk to, go apply for a mortgage without doing the opt-out pre-screen. Your phone will blow up. You'll have more people to talk with than you could ever imagine because it is, as I mentioned, I'm chuckling because I'm trying to make light of it, but it makes me crazy. So again, that's the Trigger Leads. If you're curious what it's all about, Google Trigger Leads. You'll see what I mean. And there are different organizations that are trying to get bills in Washington to ban it. But right now, opt-out pre-screen is your best bet. So great question. I hope that helps, and I'm sorry that you're going through that. All right, guys, you hear the music. You know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards, and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Guys, if you have questions or comments, it's not too late to get them on the air. You can call or text 855-462-7292. That's 855-462-7292, or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. And right in the middle of the page is a big orange button that says Get Your Questions on the Air. Just click that button, follow the instructions, and Jen will read your questions on the air. But guys, let's keep the questions coming. I know Jen's got some ready, so let me throw it her way. Hey, Jen, go ahead.
Chris sent this text. We want to keep our house, rent it out, and buy another house. How long do we need to have our house rented before we can get a new primary home mortgage? I found 6-month rental. I'm just not sure if that's long enough.
Our house in the middle of the street. Our house. I'm sorry, guys. I sang in the opening segment, and now I long for song. Anyway, this is a great question. The good news is you don't have to go do that 6-month rental thing. You can sell your house and buy the new house right now with no waiting time in between. Here is the guideline requirements, though. You need a lease in place and 2 months payments. Now that can be first and security. Now the lease can start after closing, but you need a lease in place and have collected 2 months. And there is some smart mortgage person out there right now saying, well, Mark, that's only true with Freddie and not Fannie because Fannie doesn't require the 2 months. That's true. You could get away with as little as just a lease in place, but to play it safe, a lease in place plus first and security, you are good to go. You can move out of your house into the new house, close on the new house. The tenant can move right into the existing house, and that mortgage payment will not be counted against your debt to income ratio, the mortgage payment on your current house, assuming that the rent covers it at the proper ratio. That's the only caveat. So if you have a tenant lined up and they're okay with taking occupancy after you close on the new property, you don't have to wait. I hope that helps. This is a very, very confusing subject. And then we get into the whole thing, when do I claim the income on my taxes? We can discuss all of that. Income and taxable income are two hugely different things. Every penny that you collect in rent is income, even if it's written off with the mortgage and management and expenses of the property so that you don't have to pay income tax. You do need to claim that income if you want to continue to use that rental income to offset future underwriting debt to income ratio circumstances. This one gets a lot of people wrapped around the axle, so I appreciate that one. Hey, Jen, throw me another question.
Ronnie emailed this. Now that rates have pulled back, I think it may be the right time to refinance and pay off some debt. Do you think we should wait to see if rates keep dropping?
This is a great question. If it was me, I might wait to refi. I might not wait to buy. And we went into that in detail in the opening segment. And if you missed the opening segment, guys, just wait a few days and go to Mr. Mortgage Radio. This will post as a podcast episode in about 3 or 4 days. When it does, you can hear that opening segment where we talked about all of the situations around a falling rate environment, and maybe buying ahead of that falling rate environment makes sense. But if I was refining and I've waited this long, I might hang in there to see what happens with rates. But it's the best that it's been in a long time. So I understand the desire to do it. And a lot of people are using some equity to buy that rate down. So if you're in a pinch and you're able to buy that rate down, you could get into the mid fives pretty easily with a debt consolidation refi like the rec refi. So great question. I would need to know a little bit more about the circumstances surrounding it, but I don't know that I would be opposed to waiting just to see if you can pick up another 1/4 of a point, which every 1/4 of a point counts when you're doing a debt consolidation refi. But great question. Hey, Jen, can we get another one in? Okay, let's go ahead.
Sandra sent this through the website. This is the second time in 3 years my insurance is canceled. The new quotes are ridiculous. What will my mortgage company do if I can't find affordable insurance? Great question, Sandra.
Yeah, this is a great one. Man, oh man, I am so sorry to hear this. And there's no comfort in knowing that you're not alone. This is affecting a lot of people. I mean, a lot of people. Whether you're in California and it's the fires, whether you're the middle of the country and it's the tornadoes, or you're in the coastal regions affected by hurricanes, you're all feeling it more so than everybody else. And we've been through this many times in my household. We get that letter too, and God, it drives me crazy. But to answer your question, your mortgage company is going to require that you carry insurance for either the replacement cost of the property or the mortgage amount, whichever's less. So when you're getting these competitive quotes, make sure you're not asking for too much insurance. Make sure if you've got a lower mortgage balance, and I'm not suggesting that you go out there and underinsure yourself against risk, but if you truly can't afford the premiums, make sure you're not paying for more than you have to, because if you don't buy the insurance, your mortgage company is going to force place your policy because you have to have it. And man, if you think the quotes you're getting are outrageous, wait till you see what a force-placed policy premium looks like. They are ugly. So it's worth it to suck it up and fight through the frustration and go through line by line your deductible, your personal property. Make sure all of those numbers are where they need to be so that you can get a competitive quote that still adequately insures you. I talked to a client, I don't know, a week or so ago that had one of those plastic sheds from either Home Depot or Lowe's, one of the big box home improvement stores. And, you know, they snap together or screw together, but they're basically plastic. They're not, you know, a substantial building. She said when they bought it, it was several $100s, but less than $1,000. Well, that was insured for $10,000. The structure, not the contents. So why would you have a $500 plastic shed insured for $10,000? That's what I mean. Go through the policy and just make sure that any of the assumptions are made in the direction you need them to be made. And then know that your ceiling is the replacement cost or the mortgage amount, whichever's less, and not the original mortgage amount, the remaining balance. So if you had a $300,000 loan 10 years ago and it's paid down to $240,000, that's going to be the required amount. So I hope that helps. And if you need an insurance agency referral, somebody that's going to roll up their sleeves and do their best to find you a competitive insurance policy, just let us know or visit MrMortgageRadio.com. There's a HOI policy review link. You can get in touch with us there and we'll put you in contact with a homeowner's insurance agent that might be able to help. And sometimes, guys, the state pool or the state insurance company is not the end of the world. Like in Florida, it's Citizens. And a lot of people say, oh my God, I'm going to get stuck with Citizens. The rates are horrible. You would be surprised that oftentimes the Citizens insurance rates are favorable by comparison. So now Citizens is a whole nother can of worms. There's legislation that could require, if you can get a insurance quote within a certain percentage of your Citizens quote, you're required to move. But worst case scenario, do whatever you can do to avoid a force-placed insurance policy circumstance because it gets super, super expensive in a hurry. So I appreciate the question and I hope it helps. And guys, I think that's the wild card in all of this housing bubble talk. I don't think it's interest rates. I don't think it's housing prices per se. I don't even think it's the whole affordability crisis thing, because we've talked about the percentage of people who own homes is statistically where it's been historically. So it's not that suddenly we have fewer people owning homes. I think the affordability crisis moving forward, at least for existing homeowners, is this wild fluctuation in either cancellations or increased premiums in policies moving forward. But we'll see. Hopefully there's some relief in sight, but the insurance component of owning real estate can be super expensive in a hurry. But I appreciate that question. Hey, Jen, can we... Oh no, I hear the music. You know what that means? We have wrapped up another episode of the Mr. Mortgage Show. How did we do that? How did the last hour fly by? Guys, I have way too much fun when I'm behind the microphone. I hope you do as well. Hey, if you need us during the week, check out MrMortgageRadio.com. That's MrMortgageRadio.com. All our contact information is there at MrMortgageRadio.com. Otherwise, Jen and I will be back next week right here, same time, same station. Guys, have an awesome week.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.